Hello, listeners, and welcome to the final program in our 5-part series of Let's Learn Accounting, which is actually produced for JSC Grade 9 learners and anybody else who has an interest in the subject. My name is Mr. Hanganeni Levine-Wheeler, and today we are going to learn about financial statements. As usual, please be in possession of a pen and a notebook so that you can take notes of all important points that we are going to discuss in class. And don't forget to take part in the quiz at the end of the program. Financial statements are formal records of financial activities of a business, a person or other entity. Financial statements are important because they contain significant information about a company's financial statement or status. Financial statements include income statement as well as the balance sheet. Those are the two important financial statements that we are going to learn today. By the end of this program, you should be able to identify the following concepts, which are the cost of sales, the gross profit, net profit, as well as the net loss.
Hey, listen, last night I overheard my dad telling my mom about his business. He was saying for the past 4 months the business has been making losses. He went on to say that the expenses incurred were more than the profits being realized by the business. Sales were decreasing each day and sales returns were at all-time highest level. I could hear the fear in his voice.
Wow, that is interesting. Coincidentally, my dad was also talking about the same things. About people being laid off at his workplace because the business was making losses and the business financial statements are not in good shape or something like that.
That's my cue to get to class.
Ish, you guys, may you please keep quiet?
Sorry, sir.
Okay, good morning, class.
Good morning,
Sir. Okay, please, let's take our seat. Today, we will talk about financial statements, and we will be focusing more on the income statement. Can anybody tell us what an income statement is all about?
Mr. Jones, I believe an income statement is a statement used to calculate net profit or net loss. Net profit is calculated by subtracting total expenses from total income.
That's good. Thank you, Maxine. Just to emphasize more on the income statement, is the place where you enter all the income and all the expenses. The statement is drawn up from the business results for a specific accounting period, and it indicates how revenue are transformed into a net profit or a net loss. Let us look at the components of the income statement, which includes, among others, the sales or the sales turnover.
Sir, I know about the sales turnover. I think it measures the amount of sales of goods in the business or the total income received from the sale of goods during the financial period. To get total sales turnover, we subtract sales returns, if any. Sales return is when a good that has been bought is sent back to the seller by the buyer for reasons like it could have defects or may have expired.
Oh, Maxine, you said everything I wanted to say.
Don't worry. Now let's move on to the cost of sales, which is the total cost of goods that is actually sold during the financial period. How do we calculate the cost of sales?
Sir.
Okay, Maxine?
To calculate the cost of goods sold, we start with the stock the business had at the beginning of the year, which is called the opening stock. We then add the stock purchased during the year to total stock available to be sold, but not available stock is sold. There will still be part of it available at the end of the year. The stock at hand at the end of the period must be deducted from the actual stock available to give the cost of goods sold. The formula is cost of sales will be equal to opening stock plus purchases plus carriage inwards minus closing stock.
That's wonderful, Maxine. Austin, what do you think we calculate purchases?
Finally, sir. Okay, let me try now. It just can't be Maxine. Cost of purchase, it measures the amount of goods bought for resale in the end of the financial year. And purchasers returns occurs when a buyer returned goods he had purchased from a supplier.
Excellent. Try this example. The formula of purchases is purchases minus purchases return. For instance, the purchases is 20,000 Namibian dollars and the purchases return is amounting to 3,000 Namibian dollars. Calculate purchases using the formula. Maxine, may you try?
Purchases will be equal to purchases minus purchases returns, which will then be 20,000 Namibian dollars minus 3,000 Namibian dollars, which will give us 17,000 Namibian dollars.
Impressive work, my dear. Keep it up. Next is carriage inwards and closing stock. Carriage inwards are referred to all the costs incurred in bringing goods into the business from the suppliers. Can anyone explain?
I say, I got this.
Explain what is a closing stock is.
Closing stock is the amount of stock remaining in the business at the end of the financial year.
That's good, Austin. You gave me the exact answer I was looking for. Who can use the example above for the following figures to calculate the cost of sales?
Sir, I would like to try. Let us always remember that the formula for cost of sales is cost of sales will be equal to opening stock plus purchases plus carriage inwards subtracting closing stock, which will then be 13,000 Namibian dollars plus 17,000 Namibian dollars plus 4,000 Namibian dollars minus 15,000 Namibian dollars, which will give us 19,000 Namibian dollars.
Wow. Now that we have the sales turnover and cost of sales figures, we can now calculate the gross profit. The gross profit indicates the amount of profit to cover the expenses. Gross profit is actually equal to sales turnover minus cost of sales. Austin, can you calculate the gross profit using the example we used before?
This is easy stuff. Okay, since the formula for gross profit is gross profit equals to sales turnover minus cost of sales, I will take the sales turnover of 60,000 minus the 19,000 of cost of sales, which will give me 41,000 gross profit.
Next, we have gross income. Gross income is equal to gross profit plus other income. Other income is income that does not come from a company's main business. This, for example, can be other income as discount received, whereby if we receive a discount from the supplier, or rent income and interest on fixed deposit. For example, if gross profit is 41,000 and then we received a rent income of 26,000 and then another interest on fixed deposit of $1,000, can someone calculate the gross income? Maxine, is it not this easy?
It really is, sir. So the gross income will equal the gross profit plus other income, which will then be the $41,000 plus the $26,000 plus the $1,000, which will then give us $41,000 plus $27,000, which will then be equal to 68,000 Namibian dollars.
Marvelous work, Maxine. It seems it was one of those easiest one again. Next one is expenses. These are operational costs in the business or costs incurred in carrying business transactions. Let's use the following example to find the total expense. Let me say we have salaries of 9,000 and then we have to pay telephone of 7,000 and then stationaries of 1,000 and then loan or interest on loan of 3,000. And then we must also have to pay water and electricity of 4,000. And then there's also a carriage outwards amount of 2,000. Austin, can you calculate the total expenses, please?
Okay, sir. So here's what I would do. I'm just going to add all the expenses together. So I'm going to take the salaries 9,000 plus the telephone 7,000 plus the stationery 1,000, plus the interest on loan, 3,000, plus the water and electricity, 4,000, and lastly, the carriage outwards, 2,000. I'm going to add all of them together and it's going to give me an answer of 26,000.
Definitely, you are right. Next one is the net profit. The net profit is actually when income exceeds expenses. Net profit is equal to gross income, you less expenses. Maxine, help us calculate the net profit using the examples as illustrated. And you can also help us explain what a net loss is.
So I think we would have to take the gross income minus the total expenses, which will be 68,000 minus 26,000, which will then give us 42,000 Namibian dollars. 42,000 is a profit because net loss is when the expenses exceeds the income. Therefore, this cannot be considered as a net loss.
I am very happy and impressed.
Thank you, sir. I have learned a lot today. I have learned that sales return measures the amount of goods of sales in the business or the total received from the sale of goods during a financial period. Take two. On the other hand, I also learned that opening stock is a stock brought into the business in the beginning of the financial year.
I have also learned that purchases measures the amount of goods bought for resale in the end of the financial year, and that closing stock is the amount of remaining stock at the end of the financial year.
You guys are so great. And that brings us to the end of today's session. But as usual, here is the question for today. The question is that the cost of bringing goods into the business from the suppliers, what is being referred to in the above statement? Is it a sales return inwards? That's number one. Number two, is it a carriage inwards? Lastly, is it a transport expenses? This program was written by Taten Dandawi. So until next time, goodbye.
This program was brought to you by NAMCOL with funding from the Ministry of Education, Arts and Culture and the Commonwealth of Learning.